You want to know the one crypto tax strategy that you should know? Well, I'd say listen up. My name's Kenner French. This is going to be very informative. A lot of people don't know this strategy that I'm going to be talking about today on this podcast. And who am I, by the way? My name's Kenner French. Once again, I'm with vastsolutionsgroup.com, where we do tax finance and artificial intelligence to lower tax liability for small business owners. You know, one of our specialties is crypto. In fact, we're the first vendor to allow inside of a 401k or an IRA cryptocurrencies, meaning Bitcoin, Litecoin, et cetera, et cetera. So anyway, let's talk about this. What's the one tax strategy that's really important to know? We're talking about crypto, because cryptocurrencies are classified as property rather than a security in the eyes of the IRS. The wash sale rule does not apply if you sell cryptocurrency holding for a loss and acquire the same cryptocurrency before or after the lost sale. So meaning, let's say you bought, crypto at 100, then it goes down, then you repurchased it. You wouldn't be able to do that in a security. It's called the wash sale rule. But in cryptocurrencies, you could do that. Now, we'll talk a little bit more in depth about that. But it's something truly to know about. Someone would say, well, wow, why is a company that does tax finance and artificial intelligence for entrepreneurs talking about this? Because I think more and more people should be doing cryptocurrencies, especially down the road. It truly can be cryptocurrency. The space could truly be really kind of mainstream. You just have a garden variety, short-term or long-term capital loss depending on your holding period. You don't have to worry about wash sale rules. Luckily, right? Now, this favorable federal income tax treatment, it's consistent with the long-standing treatment of foreign currency losses, as a matter of fact. That's a good thing, because folks who actively trade cryptocurrencies know that prices are very volatile, especially, one day it could be worth, cryptocurrency could be worth whatever, 10,000, and then all of a sudden the next day it could go to 8,000, the day after it can go to whatever, 22,000. That might be a bigger price swing than is out there, but I'm just making kind of an illustrative point there. That's truly, you got to take that into account when you're investing in cryptocurrency. Don't invest in cryptocurrency unless it's right for your situation. Please talk to an advisor so you're doing the right thing in your circumstance. What I would say is the volatility gives you two opportunities. One, profit on the upswing, and you can do loss harvesting on the downswing. So let's take a look at harvesting of losses. Okay, now let's say on day one, someone, let's call him Lucky. He pays $50,000 for a cryptocurrency, a basket of cryptocurrency, or one specific cryptocurrency. On day 50, Lucky sells the cryptocurrency for $35,000. So he bought it for $50,000 and it's gone down to $35,000. He captures and deducts the loss, that being $50,000. Again, $15,000. $50,000 minus $35,000, obviously. What's the net? $15,000 as a loss. Put that on your tax return. That's what Lucky would do. On day 52, a couple days later, Lucky buys the same cryptocurrency for $35,000. His tax basis is then what? In that case, brand new clock starts. It's $35,000. Now, on day 100, so now we're talking about 100 days after day one, Lucky sells the cryptocurrency for, let's just say, another lower amount, $15,000, so it's gone down. He captures and deducts a $20,000 loss. So now it's $35,000 minus $15,000 on his tax return. Now on day 103, Lucky buys that same cryptocurrency. Let's just say it's worth $15,000. Now on day 365, so it's been a year from the first purchase of $50,000. The cryptocurrency is trading at $55,000. Lucky's happy. It worked out, right? Now let's talk about that. What an observation. Let's assume Lucky had $35,000 in capital gains. Lucky deducted his $35,000 in cryptocurrency capital losses. Now, if he had no capital gains, he had a $3,000 deductible loss and carried over with him the $32,000 forward to next year. Now, on day 365 days, to be exact, from when we started, Lucky has his cryptocurrency, which was his plan on day one all along. He thought it would go up in value. It did, from the original $50,000 to $55,000. So Lucky's tax basis in this cryptocurrency on day 365 is Yep, you got it. $15,000. Now, this is what Lucky ultimately did. He kept his cryptocurrency. He banked the $35,000 in losses. Now, losses from crypto-related securities, quote, securities such as Coinbase, that can fall under the wash sale rule, potentially because the rule applies to losses from assets classified as securities for federal income tax purposes. But for now, cryptocurrencies themselves are not classified as securities. So here's your planning point. If you want to harvest losses, make sure you hold cryptocurrency and not as a security, but cryptocurrency itself in a cold wallet, usually in a cold wallet. Now that you know this strategy, you're better armed to fight off Uncle Sam. All legal. This is all legal. This is how the tax code is written. By the way, what I should note is there's been some talk about instituting a wash sale rule for cryptocurrencies. Now, if that's the case, obviously what I've talked about is null and void. Now, what I would say is, if you have any questions, because the taxation of cryptocurrency can get very, very, very sticky, please give us a call. How? 888-808-8278, extension 710. Check us out on the web. We have a lot of resources on the web at www.vastsolutionsgroup.com. Again, www.vastsolutionsgroup.com. And once again, this is Kenner French with vastsolutionsgroup.com. I really appreciate you taking the time. Hopefully this has been helpful and you've learned just a little bit more than you would have known otherwise about cryptocurrencies and ways to increase your net worth by lowering your taxes relating to cryptocurrency.